Louise Bedford here, the host of the Talking Trading podcast, and I'm also known as the Money Chick. This is how traders excel. In today's show, I'm interviewing Heather Cullen. Heather Cullen is an options trader, and we met way back in the last century. You're going to want to hang around until the very end because Heather is going to reveal 3 things that are going to improve your trading starting today. Firstly, her timing tool for the market, which is simple and easy to apply, is something that you're not going to want to miss. Secondly, you'll hear how she reframes losses as tuition fees. So important for every trader. And finally, we look at the AI hype and what part of AI can you use as a trader to improve your results. Heather is going to demystify all of this and more. So let's dive right in. Heather Cullen, welcome to Talking Trading.
Thank you. Very glad to be here.
Now, you've been trading for over 25 years. What first drew you to the markets?
Basically, I wanted to stop working. So I was looking around for things to do. And I just suddenly saw a chart once that had a kind of, had a stock chart. And I thought, oh, that looks interesting. And so I started checking it out. And then strangely, as I said when we talked before, I came to one of your lectures. And this is way back last century, right? And you just look so happy and bouncy. And I thought, that sounds like a good life. And I thought, well, if she can do it, I can do it. So I kind of got my kickstart from you. That's why when you contacted me, I said, oh, I know who you are. Yes.
That is so lovely. And do you know, that is something that I think both of us have at the forefront of our mind, to be able to share the word and to spread this as being an alternative to the usual grind people have to go through.
Yes. Oh, look, I absolutely agree because, I just felt that my life was being eaten up with work, and it wasn't like I was enjoying it anymore. And it was just like, what am I doing? And so many of the people that contact me through the website and books, they're just saying, I just want to stop work. I want to do what you're doing. And I'm thinking, well, I can understand that because my life's pretty nice.
Yeah, that's a fantastic thing. And you went from sleepless nights to creating the ITM strategy. So does that stand for in the money?
Yes.
Yeah.
Technically, it should have probably been called Deep in the Money, but that didn't kind of fit on the cover. So it's just in the money. Yeah, oh, look, I tried everything. I followed this girl, Elliot Wave, like everything. I followed it, and it got so complicated, super, super complicated. And I just noticed that everything's getting worse. Like you'd make a couple of wins, and then some nights, because American trade's nights, you're just like, oh, there you go. And at the time I was living over east, so the market didn't open till I think it was at 1:30 in the morning. So there was a lot of sleepless nights, and I was still running Shadow, my business, during the day. And I just thought, this is nuts. I kind of know this is what I need to do. I know this is what I want to do. I've just got to figure a better way. And that's how it kind of started. And it was like, so the first thing, scrap everything that you're doing. Now just go and think about it. And that's how it started. So,
yeah. So was it just the frustration that led you to change your entire strategy? Or was there a particular catalyst?
No, it was just, I wasn't getting it right. I mean, you can't lie in trading. If you get it wrong, you lose money, right? Or at least you don't make enough money. So it was just that. It was just like, well, what are you doing? You're spending hours and hours and hours, and you're getting worse. Like, you really got to stop this. And that was it. It was just like, I just can't go on like this. I've got to figure out a better way. Well, actually, there was a kind of catalyst, because one year I was following someone, and I can't remember, probably about 2010-ish. At the end of the year, I'd made 20%. I was like, ooh, that's not bad. Then I realized that the market had made 32%. And I was like, is bad. Or, roughly, I'm not sure of exact figures, but I'd made less than the market and I thought I was really cool. And then another time, it was probably the catalyst, like, that's it. I was following somebody who was writing options against CFDs. And one month, I was up like about 3 or 4 times every night adjusting these trades and then go back to sleep. And I would get the alert, ding, ding, ding. Oh, God. It was really awful. Anyway, at the end of the month, the trade was successful. And I had made, I think it was like $13.50. On the trade. It was successful, isn't it? I didn't lose money, and they counted it as a successful trade. And I go, that's not my definition of success. No, I've really got to think about something else.
What is the ITM strategy then? Give it to me in a nutshell.
In a nutshell, it's two things. I don't trade particular stocks. I only trade indexes. My theory is that stocks are unpredictable. You can't predict what's going to happen. Like the CEO might die, or, they might be found to have committed fraud or something like that. You can't do that. But what you can predict is you can predict people, as in mass psychology. So that's why I stick to indexes, because they're much more predictable. There's no big surprises other than big ones you can see coming. So it's all based on SPY and QQQ, but we'll stick to SPY. So after that, we just use a very simple 10-200 cross to get in and out. And there's rules around that, but that's basically it. And then we buy deep in the money calls. So the books talk about like 50% of the strike. So let's say the SPY is at 600, which is nice round numbers. So a 50% strike is a 300, so it's exactly halfway down. A 60% strike is, 380, is it 375? You know what I mean? But 60% of the current price. So that's how we pitch them. And there's different outcomes. Like obviously the 50% strike is safer, but the 60% strike is more profitable. But that's basically it. It's so simple. When I first published the book, I used to get, how people hate things. And it's like, oh, do you think you're the first person that's ever invented options? It's like, no, I didn't say that. I just said, here's an idea. And look, I've back tested it for 30 years and it makes almost 10 times the market return, which is pretty good.
Yes, absolutely. And tell us more about your book then, because I know this is something that you hold close to your heart, and I'm not sure whether all of our people will be across what you've been doing.
I wrote my first book almost 5 years ago, and I've got it here. Ta-da. So this is the 2024 one, In the Money. It's on Amazon and on my website. I've been updating it every year just so that it stays current and adjusting it a little bit, because SPY has got so expensive that even getting a 50% one, you're needing, like $30,000. So I've also introduced a smaller one, which is on a different index, which people can get into for about 5,000 at the moment. But so that was the first book, and surprisingly, it went very well. And then I had lots of people saying, well, when's the bear? Because it was all about a bull market. And it was like, well, I was planning just on that. So I tested out the bear strategy, and then I wrote the book on the bear one, which is over there somewhere, but it looks the same. I always have the C on it, because the motto is basically trade the tide, not the waves, because you can get fascinated by the waves, but
I like that. Trade the tide, not the waves.
Yes.
Yeah. Well, let's talk more about that, because I want to hear your views about timing the market. You've said that is the advice there is sometimes misleading. I want to delve into that. Mm-hmm. Why do you think it's such a persistent myth? Tell me your thoughts.
Well, some of them aren't very flattering. I mean, first of all, money managers, they are measured by how big their funds under management is. The last thing they want is you taking your money out just because it's a bear market. They want you to stay there. And so they also give you stuff like dollar cost averaging, just keep buying, well, who actually benefits from that? They do, not you. So I've written this other book, which has nothing to do with options. It's called Time in the Market. And it looks at all of the studies that have been made about timing the market. Now, you've all heard the 10 best days, miss the 10 best days, and your profits go down. So it's best to stay fully invested. And as I point out, that's not logical. Yes, if you miss the 10 best days, you miss out on a fair bit. But the corollary, so you must stay fully invested, that is not, that's a fallacy. One of the studies is Putnam. And they're the ones that, all the big headlines, don't miss the 10 best days, stay fully invested. But even on the figures that they published in the Wall Street Journal or wherever they published it, I mean, I just look at it. If you stay fully invested, 45,000. So that's, I think, from 1,000. It's the relativities, but I'm interested in. So fully invested is 45K. If you miss the 10 best days, you only get 20K. However, if you manage to miss the 10 worst days, you would have 107K, right? And they don't kind of mention that bit. And I go on to analyze the other studies and find out that, even with their own figures, it doesn't hold up. It's just that they cherry pick the little bit that they want. So just even using the 10-20 cross says that you're out of the worst of the bear markets, you actually make 50% more profit than the market does. So all the figures are there. I mean, I always publish all the figures and I always put them on the website, so that anybody can go and double check them. And a lot of people did, but they're right. Every time I hear, it's best to stay fully invested, I really get quite angry because people believe it. They think, it's an expert and must know what they're talking about. But they don't.
So what you're saying is the complete basis for requiring a stop loss, because unless you have a stop loss in the market, you could stay in for those 10 worst days, and that is what is really going to erode your profit-making potential. That is definitely where you and I have a lovely Venn diagram of overlap, because that is something that I've been suggesting to people for a very long time. But there is some resistance around that. I think people like to think that they are individually quite special. Could you share an example in the real world about when your attitude about timing really helped and one where it didn't? And what did you learn from that?
I think it kept me out of all of the big bear markets. And I can remember way back, just before the GFC, and I've always been quite impressed by the John Templeton quote, the bear markets, they start in pessimism, grow in optimism, but die on euphoria. And just before the GFC, there was euphoria everywhere. You opened the paper and it was like, here's a black box trading system. And the other side, it was, like no fail trading system. There was all this everywhere. And I also noticed, I was still working, and I noticed that everybody was talking about shares. And people who had never bought a share in their life before were, crowing about this. I went up, And basically the attitude was, you can buy anything. It's just going to go up. Anyway, I looked at all this and I looked at the charts and I thought, no, I do not like what's happening. And then there was financial journalists as well. I remember reading one that was all about why the market could never crash again. This time it's different. It can't crash again because now we've got, how they were splitting the mortgages, this whole subprime thing. And they were using that as an argument why the market couldn't get down. Anyway, I thought, right, well, you can see the signs, get out. So I did get out. I think I got out in about this September. But of course, the market kept going up for the next 6 weeks. 8 weeks. And so there I am in work, listening to all these people. I made this. I just bought a boat. Not quite, but you know what I mean. And I was feeling pretty silly. I didn't ever talk about it, but I was thinking, I got that wrong. Anyway, the market. And luckily I was out in the sidelines. So that's a kind of example of, you stick to your guns. If you know what works and you know what's right, just grin and bear it till you've been proved wrong. Although I must say, I was getting to think I was going to be proved wrong, after about 6 weeks.
I had a similar experience in the GFC, but this relates to my father, who basically never followed a word of my advice other than this. He said to me around that time, just before it all went and dropped, he said, "Oh, I'm thinking that the market might be a bit overheated." And I said to him, "Dad, I don't have any positions in the market. This is a very unusual circumstance for me, but I've been stopped out left, right, and centre, and the positions that I'm looking to get into don't have enough volume." And he
Mhm.
said, "What do you think I should do?" Now, this is the only time my father ever in his entire life asked for advice. And I said, "You should get out." And
Mhm.
he did.
Oh,
So
well
he had a very lovely retirement with my mother, all
done. Mhm.
because he managed to
To get out.
exit
Right.
because he followed the signals on the charts.
Yeah.
So I'm not saying that it was something that it was intuitive for me. It was that the charts were the things that were revealing the signals. And with those signals, that's when I acted.
Mhm.
So, for the trader listening who would like to apply some of the timing the market
Mhm.
strategies, how do people start?
It's as simple as following the 10-20 simple moving average cross. And when you can see white space when they cross, your golden cross, you get in. Just make sure that it's actually crossed, because often it bumps and goes away. And then on the other side, when there's a death cross, when it goes the other way, you get out. It's as simple as that. Then go and buy yourself a 50% SPY option, 50% strike, or a 60% strike, somewhere in there. And that's it. Sit back and enjoy it. I was doing some back testing because I'm going to update the book. I'm going to combine the bull and the bear, and I'm also going to generalize it to QQQ, to the NASDAQ, because people keep asking me about it. So basically, that's it. And since 1993, when SPY began, it's actually made 10 times the market return. And that's crazy, I know. And, people can't just say, oh, but it's only a 2 times option and all that. But, the trick is getting out when we're going into a bear. And as well, uh, rolling, like if something goes up, let's say it's at 600 and you bought a 300 option, right? Then it goes to 700. Well, your 300 isn't 50% anymore, so you've got to roll up. And doing that, you end up like you might have started off, because we start off with $1,000, and I think you could buy, I don't know, 20 or something at the time, because it was a long, long time ago. But we ended up with well over 100 options because of the rolling and all that. So that's why I kind of run the weekly blog, because people can ask questions there. And I'll also point out, I'll do a chart reading every week and say, this is what's happening. This is what could happen. This is what might happen. And I also do a bit in each blog. I pick a topic that I'm getting asked about, and I'll do a bit of a splurge on it now. So, like, I think this week's was on trend lines, and like the one before was on on the tariff tantrums, and so I try to make them funny, and protecting profits, and Darvis boxes, and AI, and things like that. So I try to pick up on the things that people ask me about, and then write about them. And then you'll get more questions, and that gives you something else to write about. So I do that every
Yeah.
week. I had envisaged it when it started. I had envisaged it as a once a month update, they're about this long. And it's ended up a weekly this long. But I just kind of get so many lovely, lovely comments from my readers who are just so nice. And, saying how I've changed things for them and all that. It just makes it all worthwhile. So,
And you
yeah.
call your losses tuition fees. Tell me more about these tuition fees. What's one of the most expensive tuition fees that you have been charged?
Oh, golly. Well, the tuition fees, I think it wasn't me who started that. I think it was Jesse Livermore, might have. But anyway, the first one was when I was just trading in a very small way. And I listened to my then financial advisor, who said, put money into Great Southern Plantations. Right. 48,000 would be just right. So, okay. And so I put 48,000 in. And then I was actually overseas, and there was two. There's Great Southern Plantations and another one, and one was going like that. And I thought, well, and mine's going to go like that. And so I'm contacting him saying, get me out, get me out. Oh, you can't. You only get it out once a year. So that was like, okay. So I lost my whole 48,000. That hurt.
Wow.
Others, oh, I've done dumb things like I was playing with naked puss, which is fine if you're sitting there watching it and making sure. But the one time I forgot that I was going to my sister's birthday party that night. And so I was in a position and it suddenly dived. But I have to go. Oh no. So I had no choice. I had to close the position. I lost $20,000 US. And I was not very happy at the party. So that was one thing. Don't play with naked puss. But the second lesson from that is I did it again. I did it about 3 or 4 weeks later. And it was so funny. So I was going to the same place. And I was angry. I wanted my 20K. So the lesson I learned from that, I lost it again, was don't trade angry. So don't listen to anyone except yourself, except what you know is right. The second one, don't play with naked puss.
Yes.
Not unless you sit there and watch them like a hawk and get out as soon as, And then the last one is don't trade angry. The market doesn't care. It doesn't know you. It'll do what it does, whether you do it or not. So I actually really like that about the market, that it doesn't care. That's good.
Yeah.
It's just there. It's like the sea or the ocean. It's just there. It doesn't care what you want it to be like. Just there.
And you've been exploring AI, which I'm very interested in. It's definitely a pet project of mine. Where do you see AI genuinely helping traders, and where is it just hype?
Right. Look, I am AI's biggest fan. I love it. I'm always playing with different ones because I'm a nerd from way back because I was originally in IT. And I find it invaluable for just getting things like, say, look, like yesterday when I was back testing, can you just get me a list of all of the QQQ dividends and their dates and, for the last 25 years. And it thinks and it comes back with them. And then you go, that's nice, but I want it in cents, dollars and cents. I don't want it in percentages. And, never complains, never carries on, and just goes and gets it. So for stuff like that, I just think it's absolutely brilliant. But I wouldn't use it to predict, where the market's going to go or anything like that. Like any computer is only as smart as the question you ask or what data you give it. So it can't possibly know anything in the future. So AI picks stocks. AI is picking them according to some human parameters. So you might say, I want something that's in the technology area. I want it to be trading between $30 and $50. I want it to have a market cap of this. So you can pick out your profile, you give it to AI, brilliant. That's a good use of it. But if you've got your parameters wrong, it doesn't matter. They'll get you the right answer according to your parameters. So I don't see it helping traders in any other way other than just getting information, sorting information, finding, data and, going down rabbit holes looking for this or that. You can go down the rabbit hole and it can do it much quicker.
Yeah. So if somebody wanted to investigate AI and dip their toe into the water as a trader, what would your advice be?
I'd say as a research tool, fantastic. Anything else? No. But, you can use it for like back testing or something. You said, if I have done this, in this case, would this have worked? But you've got to be right on top of it. It sometimes gives you complete nonsense. And so unless you know the area that you're talking about, it comes up with weird things. And sometimes it'll contradict itself. And it'll say this. I say, hang on. In the last one, you said this. And goes, oh, well done to point that out. It's very polite.
It is very polite. And Heather, the good news is you've got a download of a short book for my listeners, Timing the Market
Okay, so
from
that's this one.
heathercullen.com/book-download. heathercullen.com/book-download. Tell us what we'll find in that link.
Well, I know that all of your followers, all of your traders, I know that they're not all options traders. So I thought this one was better because it doesn't really mention options. It points to where you can go afterwards, but it's just purely looking at the studies and the myths of timing the market, that you can't do it. Just looks at those, debunks them all, and gives you a better way of doing it. But then people are just left with nothing. So no, I wouldn't do that. There's a very simple way of timing the market, and it also points you to other things if you want to carry on with this.
Heather, you have been a delight to have on the show. I'm so glad that Eric Kendall, longtime listener of Talking Trading, suggested you as a guest. And if you have got, as a listener, somebody who you feel strongly should be on the show, I would love to hear from you. So definitely email me.
Yep.
And until the very next episode, happy trading.
Oh, happy trading to you too.